Welcome to Market Call. I'm Matt Scooby. Dan Rohinton is on the show today. He's Vice President and Portfolio Manager at IA Global Asset Management. He'll be taking your questions on Canadian and global large caps. Here's how you can reach us. You can call us toll free, 1-855-326-6266. You can also email us, marketcall@bnnbloomberg.ca. So Dan, let's get into this, shall we? We really are talking about, and you touched on too in a couple of notes, tale of two markets, the haves and the have-nots. AI pushing a lot of where we're going on both sides, but let's start with the haves, and again, really leading with the tech sector right now.
Yeah, and the tech sector, when you really want to nail it down even more specifically, is the AI-related companies and the perceived AI winners. And what that tends to do is it tends to be a bit of a gravitational force where all the money gets sucked into the NVIDIAs, the Microsofts, the Oracles of the world, and then all the derivative plays that come on the back of that. So there's not a lot of fund flows left over for a consumer packaged goods company or some other international insurance company, so on and so forth. It all becomes AI all-encompassing. And this is very much a US trend, but also I would also make the point that this is a global trend as well. So don't expect to see something all that different in the European market, let alone the Asian markets as well. So this is a global force and a tale of two haves and have-nots led by AI. Yeah,
and touch on the have-nots too, because the have-nots really, it seems like at this point, are without the AI, are not keeping in part of that investment.
Yeah, when it comes to the perceived AI losers, or just what's left behind, is the market tends to be overly focused on certain areas of growth because the economy tends to be, at all periods of time, imbalanced in certain areas. And by imbalanced, I don't mean that in a negative connotation. It's just there's market leadership when it comes to industrial production. For a while, it was automation. For a while, it was electrification. Now it's the industrial renaissance because data center is the new form of compute and intelligence. So that type of coalescing around one theme just means that everything else gets left in the dust.
Yeah, and they're trying to, slowly starting to find maybe some more footing, at least at some point down the road. The impact of the central banks, we talk about it too, whether it's in North America or globally too. We saw a couple of rate cuts, both the US and Canada here recently. That's expected to be the trend here for the next 6 to 12 months is I think what we're looking at. When we get into that, how is that going to impact, both sides of this, but just maybe markets overall?
Yeah, so going to the Canadian market a little bit, this is going to be very good news for all the gold bugs out there. And because at the end of the day, when you have inflation that hasn't fully, if we're being honest with ourselves, fully conquered as a risk to the overall Federal Reserve's inflation mandate, let alone the Bank of Canada, and focusing on jobs, that's a very nice, convenient way of saying, let's go back to negative real rates. So all the gold bugs will just be shining with excitement as to what that means. And that's really the Canada phenomenon. But the reason why the Bank of Canada is obviously more dovish and needs to be so is that we have a housing financialization dynamic on the other end, where the housing market anywhere in the GTA and parts of British Columbia are really starting to see illiquidity out there and rising losses at the margin. So that's enough for the Bank of Canada to stay dovish on that trend. And for the Federal Reserve, it's exactly what I described, which is looking the other way at saying inflation is yesterday's problem, even though it's not, and looking at unemployment, which is loosening at the margin from record generational tightness levels, and saying this is now the big problem we have to solve. Long way of saying negative real rates, good for equities across the board, as long within reason, and gold as well, which is what's been the driving forces, with the AI theme being the big conversation within equities.
Right, within and overall. Okay, great. We're going to get more into it. We're going to be back shortly with Dan Rohinton of IA Global Asset Management, taking your questions on Canadian and global large caps. Stay with us. Welcome back to Market Call. Let's get into it, shall we? An email from Steve. Steve's asking, can Dan give his opinion on the prospects of Spotify, which is based in Sweden? Thoughts, Dan?
Yeah, so when you think about Spotify, what it is historically a platform for music and the library of all of music that was created, right, licensed from the labels. They've increasingly moved towards diversifying into podcasts and other types of formats. Long way of saying, great platform, great retention, improving monetization. The tiered approach where it's a free tier, ad-supported, and a premium tier, All of that makes perfect sense. The question we're talking about today is valuation. So do you want to pay over 40 times free cash flow for this type of business? I'd be a little bit more cautious here, but although I would say over a 10-year horizon, this is still a company that I would own. But I would recognize that where we are in the value chain in terms of Spotify, I think there's actually more opportunity in the music labels itself, the companies that license to Spotify, than Spotify itself, purely because of where we are from a valuation standpoint and the tremendous run we've had so far.
Okay, good to know. Let's go to the phone lines, shall we now, too? Let's start with John, who is calling from London, Ontario. Hi, John.
Hi, Matt. Hello, Dan. Dan, I got burned on Alibaba years ago. I was in at 170. It went up to 250, and then I sold it back at about 150. It went down to 70, I think. Now the revenue's growing, the profit's growing. It's perceived as an AI-friendly stock. Is now the time to go back in on Alibaba for the next 2 to 3 years? Give me your RR, the Rohinton rating. Thanks.
Thank you, John. So what I will tell you about Alibaba is to understand just the nature of what the business is. So it's an e-commerce company and a cloud computing company, and the cloud computing part is the most nascent piece. So the short answer to your question, John, is it's a trading stock over the next 2-3 years. And the reason for that is that the e-commerce side is under a lot of strain in different capacities. So Amazon would be very nervous to see the competitors that Alibaba has in China. So be careful about Alibaba as a long-term hold, because it is not that type of company. It is very much in the here and now, seeing a lot of positive momentum because they've got AI large language models that are compelling in the context of the Chinese market, and because of their distribution reach, they can easily push that forward. So it's a trading stock. That's how I would think about it. I would say it's tactically a buy today, but I would be very careful because there is a chance you can get burned again.
Even with, they had the $50 billion AI investment announced today too. So you're still on that with that investment plan too.
Yeah, and that's where once again in China, you got to be careful about making long-term bets because the competitive intensity is very high. Yep. So what was a compelling idea 6-12 months from now might not be. And what I mean by that is someone else in China is easily going to put in $50 billion, such as Tencent, such as NetEase, such as Baidu, such as Meituan. There's so many other companies that are exactly like the Mag 7 of China that are more than willing and ready to bet the farm on whether their AI model works. So that's why I say it's a tactical buy, but a trading stock over the next 2-3 years.
Okay. Let's go to Rob, who is calling from Calgary. Hi, Rob.
Thanks for taking my call. I'd like to hear Dan's opinion on HSBC. I've held the stock for a number of years, and it's had a fairly nice run lately, and I'm wondering if I should continue to hold or take my gains and reinvest in another European, Canadian, or American bank. Dan, do you have a preferred bank and geography? Thanks again, and have a good afternoon.
Yeah, so great question, Rob. What I would say is HSBC, it's really tomato when it comes to deciding between HSBC, Standard Chartered, Lloyds Bank, BNP Paribas. And when you go further out of the European banks to, and for what it's worth, that's that's almost a criminal generalization of what HSBC does. But banks as a whole tend to move based on benign credit conditions and on same macro variables. That's why I say selling HSBC, paying the tax on it to then buy BNP Paribas. I don't want to put your tax accountant through all that pain. You're better off just holding on to it. Do I think it's a compelling barn burner buy today? I don't. I'd say at best it's a hold. And I think that the European banks are tactically more attractive than the US and especially the Canadian banks.
Okay, let's go back to the phone lines. Trevor, who is calling from Sierra Vista, Arizona. Hi, Trevor.
Well, hello, and thank you. My question, Mr. Rohinton, is on Tryg, the Danish property casualty company. I think you had mentioned previously it's like a little Intact Financial out in the Nordic countries. Here's my question. How do you analyze? What metrics do you use to see if they're pricing the risk properly? If you could please explain it. Thank you.
Yep, and for what it's worth, we still own it in the portfolio today. I still think it's attractive, and I would still hold on to it because I think once again, you framed it perfectly. It is a mini Intact, and the way you should analyze this company is there's 3 simple criteria you should look at. First, what is their Solvency II ratios, which they are in a modest excess capital position for. So expect some of that capital to come back to you. Then the main metric to look at insurance companies on property and casualty insurance is their combined ratios. And they're pretty much top notch in the mid 80s where they are. That means a profit margin about 15%. And then you want to look at their direct premium written growth and net premiums earned to understand how much of their business they're reinsuring away and what their future revenue looks like. So those are the three things I would look at. There's also so many other sub ratios. You know, it's a financial services company, so you can really go down the rabbit hole. So if you want to look at prior development to see the quality of their underwriting, that's an extra metric. Call that a bonus metric to look at.
Okay, some very good information. Let's get another caller in here. Elliot has a question from Hamilton, Ontario. Hi, Elliot.
Good afternoon. Well, this is a follow-up on the previous question. I'm concerned that with the ever-increasing number of severe events, ever more frequent, ever more severe, ever more costly, I'm wondering if the property and casualty firms can actually keep up, and they can't raise their premiums 50% a year. What do you think about that aspect of the P&C business and Chubb in particular? Thank you.
Yeah, so specifically to what you're talking about is large catastrophe events. So that generally is known as what goes into the reinsurance market. And if it's a really esoteric risk, and I'm not exaggerating when I say it is piracy risk off the coast of Somalia, that goes into what's known as the excess and surplus market, which then goes into Lloyd's of London. And that's where that type of really special risk is priced. But what you're describing is really just large catastrophe risk getting more and more expensive as time goes on. I would say that Katrina was actually the high watermark of that in 2006, and it's actually been pretty decent from there. So the reinsurance market has actually been one of the weakest, most low margin competitive parts of it, where Chubb actually takes some of their risk and offloads it into them. So I wouldn't necessarily worry about cat events, as they're known in industry speak, being a structural headwind. Generally speaking, they tend to be a little bit choppy. If you're a small company that's only insuring in Florida or only doing workers' compensation in California, I'd have tons of concerns. But for a diversified global company like Chubb, they tend to basically have enough flexibility on their balance sheet and their capital ratios that's not really an issue. So do I think Chubb, and maybe to take your question and hijack it and go into whether I think it's a compelling buy today? Mm-hmm. Not really. And the reason for that is they've actually gone through a pretty aggressive pricing cycle across most of insurance because inflation and what's known as loss cost trends have been moving as aggressively as they have in the last few years. So high inflation in groceries, high inflation in rents, and all the other things we talk about. What we don't talk about is inflation in insurance has actually been high too. So that's the reason I'm a little bit more cautious on Chubb, even though I think it's a fantastic company.
Okay, good to know. We're going to be back with Dan Rohinton of IA Global Asset Management, taking your questions on Canadian and global large caps. Let's go back to the phone lines. Joe is calling from Montreal. Hi, Joe.
Hi, I want to ask you guests about TD Bank. I bought in shortly after the bad news, so that was good for me, obviously. I wanted to ask for his outlook for this company, and I did see a story yesterday on one of the financial networks that they're looking to possibly sell off some of their branches that they bought in the other parts of the U.S. that they traditionally were in the northeastern part, I believe, and how this might affect the stock going forward. Thank you.
Mm-hmm. Yeah, and I think the company you're referring to is BMO that's doing some of the branch divestitures. But the question on TD is, first of all, congratulations. That was a great time to buy. So the stocks really come from being a discount to being the best performing bank this year. The question really from here, and I'm going to ignore tax consequences and capital gains and losses just for the purpose of simplicity. I would say where we look at from TD today, looking ahead, is I think it's no longer at the discount and the compelling value it was before, because the fears around the overhang, the asset cap, and what the cost creep could be, they've actually done a great job of clearing a lot of those elements up. And I'm sure they're going to do more of that in the upcoming Investor Day coming up, I believe in the next week or so, if memory serves correctly. So when you do think about TD today, I do think it's more fully valued. Do I think that is uniquely the case for TD across the Canadian banks? I don't. So my comments here would apply to BMO, it would apply to RBC, it would apply to the whole sector, which is the Canadian banks are trading at effectively record highs on valuation, which is normally not the case. And we're seeing credit losses and earnings trajectories that are basically as good as they get when it comes to forecasting out their earnings over the next several years. So I would take a deep breath, I would take a pause, and I would say, this is not the time to load up on the Canadian banks. This is probably the time to take some profits and buy into some companies that are a bit more defensive, because let's not forget that home prices are still under pressure in Canada, and let's not forget that the Canadian economy is on, call it, a bit more of a fragile footing than other parts of the world.
Mm-hmm. Okay, Walter is calling from Ottawa. Hi, Walter.
Hi. My question is on Taiwan Semiconductor. It's part of the AI infrastructure, and it's had a good run the last few months, like everything else. At this price point, would you be adding or would you be waiting? Thank you.
Yeah, a big year here, clearly in the last little bit.
Yep. Once again, congratulations. And I would say the best way to think about Taiwan Semiconductor is it's the unsung hero of the AI conversation. So NVIDIA gets the credit, but Taiwan Semi does actually the hard work of making these chips at the atomic layer. So one way I would put it is this is the very last AI stock I would sell, because it's also the cheapest and also has the most latent pricing power. So this is the company that invests $50 to $75 billion a year, US dollars that is, to actually make these incredible chips and make these incredible advancements. And they haven't fully captured the value of the investments that they have made. So this is going to be the company that benefits from the deepening of semiconductor technology in our day-to-day lives, including in the AI data center. So we own it, we like it, it'll be the last stock we sell. But I also don't think it's a screaming bargain at these levels. I think it's closer to a hold, but I do think there's still some decent returns to be had as we look ahead, especially relative to other AI-related companies.
Okay, let's go back and take another caller. Michael is in Vancouver. Hi, Michael. What's your question?
Hi there. My question is on Microsoft today. It was only ticking around $200 a share when I started investing, but now it's up to 500, which is an incredible market share. That's just massive. It's what, 300% per share. I mean, that's incredible growth. But I only seemed, I hold on to bigger stocks for about 3 to 6 months, and I get paranoid and I dump them. And then they seem to go up. But what's my pattern here? Is it my own education, or is it the company itself? What do you think of Microsoft? Thank you.
Hey, David, I think I caught most of that. So what I would tell you is when it comes to Microsoft, at the end of the day, when you look at what they're offering, is they're the most diversified distributor of software technology around the world. So it's not really an AI company, it's a distribution platform for the Fortune 5000 around the world. So I would say Microsoft, is it a compelling bargain today? I wouldn't say so. Do I think it's whole today? I would say so. And the reason for that is you have to look at the long term, because Microsoft will have a role to play despite whichever way the technologies go. So could you lose some time value money as in opportunity cost? Could there have been a better stock to buy? Perhaps, but we still like Microsoft today as a long-term 5 and 10-year holding.
Okay, let's do one more caller too before we go to break. David is in Ottawa. Hi, David.
Yeah, hi, good afternoon. Thank you for taking my call. Matt, I just wanted to let you know, viewers in Ottawa, we miss you so much.
Thank you, David. I miss Ottawa a little bit too.
And I hope to see you on BNN on a daily basis.
I hope that's the case.
For Dan, my question is on CNQ. And lately it's been inching upwards, which is a good thing. But oil prices have been quite stable. It's only been about $65 a barrel. Do you see any upside for CNQ? Because it's been kind of on a plateau for over a year and a half. Thank you very much for your input.
I think CNQ is one of the best managed Canadian companies that exist. And what I would say is I think it's attractive today, primarily because you don't need a huge breakout in oil prices, which are basically, if you look at West Texas Intermediate, it's sitting around $61, $62, if I recall correctly. So you don't need anything major for CNQ to deliver a decent return for you. And it's the best consolidator of the basin in the Canadian market. So we own it, we like it. Do we think it's a compelling, screaming thesis here? Not quite, But do I think it's a core part of your energy allocation and a core part of a diversified portfolio? I do.
Okay. Coming up after the break, we're going to have a look at Dan's past picks. Stay right here. Well, let's have a look at Dan's past picks. These are from September 30th of last year. We are going to start with Louis Vuitton. A bit of a tough year for that stock in particular, too, down significantly in the last 12 months or so, down to euros, just under $510, minus at 26%, and the overall return minus 24%. A tough year, but maybe bouncing back soon. But your thoughts?
We own it still, and we actually have been averaging down along the way. So basically what's happened for Louis Vuitton since we had the conversation was Chinese demand has come in, and some of the other geographies have seen a little bit more pressure, and they've had to basically reinvigorate their growth strategy, especially for their core Louis Vuitton brand, which is really the anchor of their diversified luxury portfolio. So what we are seeing more recently is that some of the data points are getting better. So we've been averaging down along the way, although I'll admit this is a bit of a stinker.
Yeah, it's not fun, I'm sure, to see some of those numbers. Let's go to Visa. This was the other one, too, that has had a very good year. I think anybody who has a stock knows that, too, for the last 12 months or so. Now up close to $340 US a share, up 23% and overall up 24%. But still holding this, at least at this point, because it doesn't look like the ceiling is there yet.
Yeah, we actually still own that in the portfolio as well, and I still think it's attractive. And the best thing about a company like a Visa or a MasterCard is they tend to be beneficiaries in different environments. So even though inflation has been a little bit better, they still get to take some market share and still get to participate in the growth of all of commerce. So we still, as with Louis Vuitton, we own it in the portfolio, and we continue to average into the position. Yeah, in this case, averaging up.
Right. Okay. So this next one is interesting too. From I was having a look at it. Is it TransDigm? I just want to make sure.
TransDigm.
TransDigm. So it's TransDigm too. Interesting too, where it has fallen the return at least down 9%, but the total return is 3% too. Holding this at least for now, clearly, or where do we stand?
Actually, I think this is increasingly more attractive. And the reason that it's now -9, but the total returns +3, is because what they do is they do big special dividends. So it makes the stock price look worse, but you're getting a bunch of cash along the way. So I think TransDigm is actually uniquely attractive today. We're buying more in the portfolio. Once again, not that different from the other ones. But what makes TransDigm special is they're in a very attractive end market, which is aerospace. So they make the seat belts, the faucets on the plane, and those tend to come with pretty normal ordering cycles. So TransDigm more recently, the reason the stock's been a little bit weaker over the last few months is that they actually saw some destocking happening in some of their verticals in aerospace. But we think that's going to be just a transient element, and it's just going to be normal course of operations, and you're still in an attractive industry with a great management team and a balance sheet that's under leverage. So we like it today, more so now, irrespective of the performance.
Okay. We're going to be back with Dan Rohinton of IA Global Asset Management, taking your questions on Canadian and global large caps. Stay with us. Let's go back to the phone lines. Gail is in Manotick, which is just south of Ottawa. Go ahead, Gail.
Nice surprise, Matt, to see you hosting today.
Thanks, Gail. Appreciate it. What's your question?
Dan, I'm reading an article in today's Globe and Mail about single stock ETFs, and I would like to know your opinion about owning the stock as opposed to owning a single stock ETF. Is there an advantage in one of them over the other? I'm not sure. Thank you.
Thank you for the question. I didn't quite catch that article today, so I don't want to I'm not sure where I was going with that, but what I would more generally say about single stock ETFs versus owning the stock, what we tend to focus on is we tend to focus on the stock itself because there's no need to really add on a small management fee and so on and so forth when you can just buy Amazon itself. What tends to happen with single stock ETFs is they become vehicles for more leverage. So what's becoming increasingly popular, and what I would caution you against a little bit, is leverage 2x, 3x leverage versions of Amazon, 2x, 3x leverage versions of Google, or any of the other major S&P 500 companies. So when you think of single stock ETFs, maybe there's a FX benefit here and there, and maybe that offsets the fees. I'd say, generally speaking, you want to stick to as simple as it gets, which is own the direct stock if that's what your preferences are. But definitely be a bit more cautious about the more popular end of single stock ETFs, which is the leverage version of those.
Okay. Gulam is in Toronto. Hi, Gulam.
Hi there. Good afternoon to you both. My question is on GE. I used to own the GE shares years ago, and then I received three: the GE Aerospace, Vernova, and I think the Health Services. And they've done pretty well in the last year or two. I'm just wondering whether I should continue holding them for further upside. Do you see further upside, or should I sell them at this time?
Mm-hmm.
I'd appreciate your opinion. Thank you.
So I don't want to generalize the different parts of GE because they're actually fundamentally different. So GE Healthcare is large capital equipment. Think of MRI machines, if I recall correctly, those types of big assets. That's very much centric on whether hospitals are profitable or not, what the reimbursement rates are. So I would say the least optimistic on GE Healthcare because I think it's got the most difficult path ahead. GE Vernova makes all the gas turbines, and it's basically sold out for the next 5 years, and they're doubling prices, and that's what's reflected in the stock. Do I think it's getting a little bit more richly valued today? I do, but this is your way of owning NVIDIA in industrials, to put it very simply. So GE Vernova will do what NVIDIA does, what Avago does, what all these other companies do in the AI space because it is at the very tail end of that whole demand curve. And then when it comes to GE Aerospace, this is the big engine maker, and it's got the best multi-year outlook. And investors are already effectively, we own the stock today just to be fully, to give you full disclosure. We own the stock, we like the stock, although I do think it's getting a little bit more fully valued today. So I think the easy money in all the GEs combined has been made, but I would still be broadly optimistic over a 5 and 10 year horizon on GE Vernova and GE Aerospace.
Encapsulates everything. There you go. Okay, let's go again back to the phones. Chris is calling from Delta, BC. Hi, Chris.
Oh, good morning. Dan, thank you so much for taking my call. Dan, first of all, I'm wondering if you put out any sort of investing newsletter to the public because I'd love to subscribe for it. I find you to be incredibly insightful and bright, so thank you for sharing your thoughts on so many companies and coming on the show. I'm wondering if CN Rail, absolutely, you deserve it. I'm wondering if CN Rail is a stock that you find attractive at these levels. I just averaged down. Again, I'm a 29-year-old investor, long time horizon, and I'd love your thoughts. Thank you so much.
Well, I appreciate that. I only post on LinkedIn, so I don't have any other social media or any other publications. But what I would say when it comes to your question on CN Rail, and I'll maybe zoom out a little bit and give you maybe a more attractive opportunity set. I think CN Rail is attractive today, and I do think in the narrow sandbox that is Canada, I do think it makes sense. Their assets are pretty robust. What they've got in terms of capacity expansions in Prince Rupert do make tangible sense and should help volume and throughput and act as basically an auxiliary port to Vancouver and Port of LA. But I would say there's also a lot going on in the world of rails, and I would maybe take a closer look at Union Pacific, which is in the process of buying their competitor and creating the first transcontinental railroad. And that is really one of those opportunities that comes once in a generation if they can get it right. So do I think CN Rail makes sense to average down? I do. Do I think that UNP might be a better opportunity today if you want to expand your sandbox further out of Canada into other parts of the world? I think that'd be a better opportunity.
And do you have a timeline on that, or that's happening right now?
It's happening right now.
Happening right now.
Yeah.
Okay, interesting. Let's go to our next caller, too. John is calling from Hamilton. Hi, John.
Oh, hi. How are you?
We're great.
Great. Thanks for taking my call. So I'm traditionally a Canadian dividend investor. I tend to focus more on income. And so I buy a lot of the aristocrat stocks in Canada. I really don't go into the States. However, I am missing out on potential gold or technology stocks. I'm not embracing that, and I feel that I should. I mean, I'm getting a lot of information, and I'm willing to open up to more growth versus income, perhaps investing $20,000, $30,000 into those stocks. With that in mind, is there a Canadian stock, not necessarily dividend, one that focuses on growth, that's either gold or technology that you could recommend?
So I want to maybe this is a chance to maybe give you a little bit of a sermon there, John, but I think it's important to just make the point that the Canadian market as a starting point, I think in Canada we see RBC and all the businesses around us and think that's the end all and be all. We always make the statement and say we're better locally because we think globally. So the best technology companies out there in the world are most certainly not in Canada. As much as I wish that was the case, it's simply not the case. So the best technology company in Canada is far and away Shopify, but they are very much a small, medium business e-commerce enablement platform. So it's not really AI. The other company that's closest to AI is a company called Celestica, but it is by far more vulnerable in the AI value chain compared to a Taiwan Semi, compared to an NVIDIA, compared to a Microsoft and anything else that's available in America. So I would say if you are looking for technology, please don't start in the Canadian market, invert the conversation and go to Canada last. When it comes to gold, that is where you can start with the Canadian market because Canada is one of those basically the network nexus points for the gold market. My issue with gold in general is what in the world isn't priced in already? So we own gold in our Canadian portfolio because we want to stay true to what the opportunity set in Canada brings. But I find myself asking the question all the time. We're already talking about debasement. We're already talking about negative interest rates. We're already talking about central bank buying and basically on a programmatic basis by the Chinese government and so on and so forth. So what in the world else could we play for in the gold market? I'm not quite sure. Outside of maybe thinking that the metal, the miners are going to have a catch up with the metal and more so. But more than anything, I'd be a little bit more cautious on gold from where we sit today. Although I'd acknowledge it's been a phenomenal return over the last 2 years. And for technology, I would just say start in America, start in Asia. Please don't start in Canada.
Okay, we're going to be back with Dan Rohinton of IA Global Asset Management taking your questions on Canadian and global large caps. Stay with us. Welcome back. We're going to get to some more emails right now. Sandy has emailed in saying that she's interested to hear Dan's thoughts on Puma stock. Dan, what do you think about Puma?
So I'll start by saying the market that Puma operates, the sandbox that Puma operates in, is a tough one. So you have to be a bit careful. So what you're buying Puma for is on a major turnaround, inventory destock, and the potential that there's a buyer out there that's looking to pick up a marquee asset at a discounted valuation. That all sounds like if, then, maybe, and probably not so in what is already a very tough market. So Nike's had struggles, Adidas has had struggles. There's a lot of competition that comes from Antisports and Li Ning in China, and the Chinese sneaker market and broadly apparel market is fast growing, but also extremely competitive, and the foreign companies are losing share there. So I would say, sure, it's a flyer. It's part of the very far end of the Explore portfolio in your Core and Explore, but I'd realistically just stay away from it.
Yeah. Another email from Lorenzo, who is asking, what does your guest think about Fairfax Financial Holding, and does he own it?
So in the Canadian portfolio, yes, we do. And the reason I would look at Fairfax Financial is think of it as in the defensive part of Canadian financial services. So Fairfax basically has, and really they kind of nailed this part of the cycle where the underwriting profitability historically for Fairfax was a bit of an issue, but that has been getting consistently better. And that's been the core reason why the stock's been doing a lot better. What's also interesting for Fairfax is that they were very, very, very short duration, as it's known in the fixed income world, for their investment portfolio, their float, as Warren Buffett would call it. That's great news when interest rates went from 0 to not quite 0 from where we sit today. So Fairfax's opportunity is to really what's known as term out their investment portfolio, and it trades at a reasonable valuation. Although I would once again caution and say with a lot of stocks in the market today, even the ones that aren't necessarily AI-centric, it is not a screaming bargain today, but I do think it makes sense as part of a diversified portfolio, especially as we pivot a bit more away from the banks and get a bit more defensive.
Okay. We touched on banks a little bit earlier, too, but we have an email from Bert asking for Dan's opinion on Laurentian Bank. Where do we stand on Laurentian?
I think the most important thing to think about with Laurentian Bank, funny enough, is Laurentian basically tried to sell itself, and no one bought it. So you always have to ask yourself the question is why? And I would just say there's other banks that are out there that are in a better position. And Laurentian is at a discount. It has always been at a discount. The opportunity is very much a Canadian Western Bank, National Bank type of merger opportunity. But I would just say in that case, you probably want to stick with National and get the better, more diversified Quebec bank that's there with the same capital optimization opportunity. But more than anything, Laurentian Bank is just in a tough spot from where they sit today because Laurentian has to compete against the big banks that are getting bigger and more consolidated. And when they put their hand up and said, we're for sale, no one bid.
Okay, let's stay in the inbox. Jasmine has sent us an email, is asking for Dan's opinion on DraftKings, please. So is it a buy, hold, or a sell? Just thanks.
I think over a long-term horizon, I think DraftKings is actually interesting. In the short term, tactically, it's a bit more of an open question about what the growth factors do in the broad market and what is the rate of basically legalization of online sports betting. Online sports betting is a very nice, pleasant, sanitized way of saying gambling on your phone. Mm-hmm. So is gambling on your phone becoming more popular over time in the United States and becoming more ubiquitous and normalized in our culture? It absolutely is. And this is not a statement on whether that's good or bad. That's just a statement of fact. So DraftKings is a proxy and a beneficiary of that trend that is going on. And there are still many states that need to legalize it. And there's a lot more deepening of that type of engagement. And if you want a bit more diversification, because DraftKings is very much pure play U.S., pure play deregulation of online gambling, sports betting, and the continuation of that trend. If you want a little bit of a lower beta to that dynamic, Flutter, which is the owner of FanDuel, which is the bigger competitor to DraftKings and based out of the United Kingdom, might be a better proxy for that. So I would say Flutter or DraftKings, tomato, and both are attractive over the long term. And it's basically tapping into a part of our human nature that we probably would not really want to encourage, but we're here to make money in stocks. Mm-hmm.
Another email, this one comes from Matt. Just curious on your opinion on Cameco Corporation and the uranium sector. Is it a good time to take a position right now?
I'd say wait for a pullback. And that's not because we're negative on uranium. It's just that the whole world is wildly optimistic on uranium and for very good reason. And the reason that they're attracted to it is if you're building out gigawatts and tens of gigawatts of power, you need uranium and nuclear to be a part of that solution. So Cameco, AtkinsRéalis, which is call it the marketing department's refresh of SNC-Lavalin, they're all proxies on what is going on in the uranium market, which is spot uranium prices are very strong. It's a bit of an illiquid, opaque market, so you don't really have a clean way of participating in that outside of a company like Cameco. And I would say it's attractive over the long term, but you want to be a little bit careful and buy on pullbacks because the optimism around uranium is basically at a fever pitch right now.
Okay, and then we're going to get one more email in here too. This is from Sid. Sid is asking for Dan's opinion on Ford, please.
I don't have a particularly strong positive or negative view on it. So when you look at Ford and what they bring to the conversation, do I think pushing back some of the EV mandates around the United States, does that help them? It does. Do I think that them moving to a more richer profit mix, which is more full-size vehicles, think of your F-150 trucks as a perfect example of that, that's all positive. Over time, though, you are losing structural market share. So I'd say Ford is more of a value stock, more of a trading stock, more of a contrarian buy on the lows and sell when it becomes more fairly valued. Sure. Do I think it's a 10, 20-year hold with a very bright future ahead? Not quite. So I'd broadly stay away from autos as a whole. And the way to think about Ford, General Motors, and all these other companies, especially the combustion engine companies, is they're run from many different stakeholders. Shareholders are just one of them. Keeping employment, keeping the tax revenues going. There's so many other things that the CEO of Ford has to focus on. That's why you just have to be a bit careful with these companies.
Okay, covered a lot of ground today. That is it for calls and emails, but don't go away. Dan's going to share his top picks. That's coming up after the break. Well, join us tomorrow on Market Call. Greg Newman will be on the show. He is Senior Wealth Advisor and Portfolio Manager at Newman Group for Scotia McLeod, and we'll be taking your questions on North American equities. And if you miss Market Call, you can check out our daily podcast. You can find it on the iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Well, time now for top picks. And again, Dan's going to get into this. Let's start with number one. CRH is where we're going to start. So, Dan, take us through why this is one of your top picks today.
So you've probably heard of Vulcan Materials. You've probably heard of Martin Marietta, but this is their bigger brother. And this is the company that's more integrated. So they have ready-mix concrete, they have regular cement, and they have the crown jewel of them all, which is aggregates. So what makes CRH unique is that it's actually a UK company that's relisting and making its primary listing in the United States. So it's a bit of an undiscovered gem in the US market, even with the stock price doing well so far. So we own it in the portfolio. We've been adding to it on the basis of a high quality company that's seeing an aging infrastructure. So ports, bridges, roads, everything in the US is 50 years old. So that needs refreshing. And then there's more demand that comes from all of the activity you need to build around the data centers, from the energy generation to all the other infrastructure that's needed. So that all creates more demand for what is already a very tight supply market, and CRH gets to sell into that. So more pricing power, more scale, well managed, and index inclusion as we look ahead. We think it's attractive.
Yeah, and again, when you talk about that infrastructure and that investment is going to be significant here over the next number of years. Let's get into the next one, shall we? Which is, we're going to stay in the UK, in fact, actually. So LSEG Group, this is the London Stock Exchange Group. An interesting one, and as I was reading about it earlier too, Dan, so take us through why this, again, is another one of your top picks today.
So it's actually viewed as one of the AI losers, believe it or not. But over time, we think this is going to come out neutral, if not ahead, when it comes to the AI conversation. The reason we think that is because LSEG Group, what investors are really focused on today, and that's why the stock's been weak recently, is actually around their desktop, their workspace, their Thomson Icon business. But that's 10% of their profits. Let's not forget the other 90%, which just got significantly cheaper. And as you need more data, LSEG Group is the best position to do that. So we think this is a tactical opportunity because what's been going on as AI has been reaching a fever pitch, as gold's been reaching a fever pitch, this is one of those have-nots that very much doesn't deserve to be in that category.
Okay, and another interesting one. Your other top pick for today, Apollo Global, the global alternative asset manager. Why does this make the cut?
So when you think about what's going on in the alternative asset management space, Apollo's been really pushing ahead in all of the right areas. So they've pushed more into retail, they've pushed into private credit, well before all of their other competitors went down that road. And Apollo more recently, because basically spreads have been so tight from a credit standpoint, they've been left behind in the risk-on market rally, when realistically, if you have wide open capital markets and you have a big private equity portfolio and a big private credit portfolio, you can really do some optimization here. So we think when it comes to, and really I've tried to bring different conversations here, which is risk on, risk off, and somewhere in between. Apollo is one of those cyclical risk on companies that you can have as part of a diversified portfolio, and it fits with a Louis Vuitton. It fits with an LVMH. Louis Vuitton LVMH. It fits with LSEG Group. It fits with the TSMC. So think of it as this your risk on financial services company in the broad diversified context.
Okay, so we talk about a couple of those too. Do you have another? I can put you on the spot a little bit. Another recommendation is you talk about the risk on right now, people that want to be getting into it a little bit more. What else would you recommend maybe at this point as we get into this and slowly start to watch where the market's going to go there?
So when you think about risk on, you really have to think in the context of Apollo is a very clean derivative proxy. Markets go up, the value of their performance fees goes up because the value of what they're going to sell and realize for their fund holders is moving up in direct tandem. Another company that's very clear along those lines is a BlackRock. Although at $11 trillion in assets under management, you do have to wonder how much more market share there is to take there, and fixed income credit is where they're going to go. But other areas to maybe lean into and put your contrarian hat on, I would say, is look into some more of the AI losers. Think of the Accentures of the world. Think of some of the software companies that are being left for, not quite dead, but really left behind in this tech rally. So I would say there's a potential opportunity there, and that's where we're fishing today.
Okay, that's again some interesting information you covered. You covered the gamut today. Dan Rohinton, appreciate your time. Thanks for being here.
Thank you. Appreciate it.
That is going to do it for us here at Market Call today. Thank you for tuning in. We appreciate it. We will see you next time.